Understanding candlestick patterns for better entries is not about memorizing dozens of shapes or treating charts like a secret language that only a few can decode. Candlesticks are not signals in isolation. They are expressions of behavior compressed into time. Every candle tells a small story about conflict, hesitation, aggression, and resolution between buyers and sellers, and trading literature that treats candlesticks seriously always emphasizes this point first. If you read patterns without understanding the psychology behind them, you are only collecting symbols, not insight. At their core, candlesticks are about acceptance and rejection. Where price opens, where it closes, and how far it travels in between reveal whether participants agreed or disagreed on value during that period. A long-bodied candle with little wick shows conviction. A candle with long wicks and a small body shows conflict. These are not abstract ideas. They are behavioral footprints. Understanding candlestick patterns begins by asking a simple question: who was in control during this period, and did that control hold into the close? Many traders approach candlestick patterns as entry triggers, waiting for a specific shape to appear before acting. This approach often fails because it ignores context. A hammer means something very different at the bottom of a prolonged decline than it does in the middle of a random range. Trading literature consistently warns that candlestick patterns gain meaning only when they appear at locations where decisions matter, such as support, resistance, trend pullbacks, or failed breakouts. Without context, a candlestick is just a candle. With context, it becomes information. One of the most useful ways to think about candlestick patterns is as evidence of rejection. Long lower wicks near support suggest that sellers attempted to push price lower but were absorbed by buyers. Long upper wicks near resistance suggest the opposite. The close matters more than the wick itself. A candle that rejects lower prices but closes strong carries a different message than one that rejects and then collapses again. For better entries, traders learn to prioritize how price closes, not just how dramatic the wick looks. Engulfing patterns are another example often misunderstood. Many traders treat them as automatic reversal signals. In reality, an engulfing candle is simply a statement of dominance, one side overwhelming the other within a defined period. This dominance is meaningful only if it occurs where a shift in control makes sense. An engulfing candle against a strong trend without other signs of exhaustion often fails. An engulfing candle after a prolonged move into a key level often marks the moment when imbalance finally tips. Understanding this distinction transforms engulfing patterns from random triggers into contextual confirmation. Another important lesson is that candlestick patterns are better used for timing than for direction. Direction should come from higher time frame structure, trend, and context. Candlesticks then help refine entry within that bias. Trading literature often frames this as top-down alignment. You decide what you want to trade first, then use candlesticks to decide when. When traders reverse this order, letting patterns dictate bias, entries become inconsistent and emotionally driven. Candlestick patterns also help manage risk, not just entries. A pattern that fails quickly often provides clear invalidation. If a rejection candle is immediately erased, the market has spoken. Traders who respect this information exit without debate. In this way, candlesticks act as feedback mechanisms. They do not guarantee success, but they shorten the time you spend being wrong. This is a subtle but powerful benefit that improves expectancy over time. It is also critical to understand that the most reliable candlestick patterns are often the least dramatic. Small-bodied candles after extended moves, clusters of indecision, or repeated failure to continue can signal exhaustion more effectively than a single flashy candle. Trading literature frequently notes that markets turn through process, not punctuation. Candlesticks reflect that process when you learn to read them as sequences rather than isolated events. Ultimately, understanding candlestick patterns for better entries means shifting from pattern recognition to behavior recognition. You stop asking, "Is this a hammer?" and start asking, "What happened here? And does it make sense, given where we are?" This shift slows you down filters, impulsive trades, and improves entry quality, not by predicting the future, but by aligning participation with visible shifts in control. And it is right here when candlesticks stop being signals you chase and start being evidence. You interpret that entries become cleaner, risk becomes clearer, and your relationship with price action deepens into something far more reliable than memorized patterns. Even though this understanding itself has not yet fully reached its end, because once candlesticks are understood as behavior rather than symbols, they begin to change how you wait as much as how you enter. At this stage, traders stop scanning charts looking for patterns and start observing price with patience, allowing candles to confirm what context has already suggested. This patience is not passive. It is an active refusal to participate until the market reveals enough information to justify risk. Candlesticks become a form of dialogue. You wait the market speaks, and only then do you respond. One of the most important developments here is learning to read sequences rather than single candles. A lone rejection candle can be noise. A series of candles failing to make progress tells a story. When price approaches a key level and momentum stalls, bodies shrink, wicks grow, and closes lose direction. The market is signaling indecision. This indecision is often more informative than any textbook pattern. It tells you that effort is no longer producing result, a classic behavioral precursor to rotation or reversal. Traders who understand this stop looking for the perfect candle and start recognizing when pressure is quietly dissipating. Better entries also come from understanding follow-through. A strong candlestick means little if it is not respected by the next few bars. One of the most common mistakes is entering immediately after a dramatic candle without waiting to see whether control actually persists. Experienced traders allow one or two additional candles to confirm that acceptance has shifted. This confirmation often results in slightly worse price, but significantly better odds. Trading literature consistently shows that patience after the signal often improves expectancy more than perfect timing at the signal itself. Another refinement comes from aligning candle behavior with volatility. In high volatility environments, large candles are common and less meaningful. In low volatility environments, even modest expansion carries weight. Reading candlesticks without considering volatility leads to misinterpretation. A candle's significance is always relative to recent behavior. Understanding this prevents emotional overreaction and helps traders stay selective when markets become noisy. As this skill matures, candlestick patterns also begin to inform trade management. Strong continuation candles encourage holding. Weak follow-through suggests tightening risk or taking partial profits. Failed patterns offer clean exits without argument. In this way, candlesticks remain useful beyond the entry-supporting decisions throughout the trade lifecycle. This continuity reduces cognitive load because the same language of behavior is used from start to finish. Perhaps the most valuable shift is internal. Traders who truly understand candlesticks feel less urgency. They no longer fear missing moves because they trust that price will reveal itself again if the opportunity is real. This trust changes posture. You stop leaning toward the market and start standing back from it. Entries become invitations rather than pursuits. This psychological distance is often what separates consistent traders from reactive ones. In the end, understanding candlestick patterns for better entries is not about learning more patterns, but about seeing fewer more clearly. It is about reading intent, effort, and response in the only place they can be seen honestly, which is price itself. When candlesticks are treated as evidence instead of promises, they guide you toward trades that make sense, structurally, emotionally, and probabilistically. And it is from this grounded relationship with price action that entries improve naturally, not through speed or cleverness, but through alignment with what the market is already showing to anyone patient enough to watch without rushing to act. If this deeper way of reading candlesticks helped you rethink how you enter trades, consider subscribing to continue exploring price action and trading psychology at a more mature level, and leave a comment sharing one candlestick behavior you now interpret differently than before.